Okay. So anyway, Fed Chairman Powell came out last week and made some comments in regards to what the Federal Reserve is going to be doing moving forward to battle something that's troubling the economy right now. And that's now the Fed made a huge misread on what inflation was going to be doing as we started the year, and we wound down 2021, claiming that inflation was, using the magic word, transitory. And in reality, we're at 40-year highs on inflation. So now they're really under the gun in what they have to do in regards to battling that. And the tool that they will use is raising the overnight lending rate, or the Fed funds rate, which right now is at 0 to 0.25%. Now, the Fed funds rate is not your 30-year mortgage rate, but that's the rate that banks charge one another to lend money to one another overnight. And once that starts to go up, historically proven, inflation comes down. Now, I think what people misread when they hear that interest rates are going up, they're talking about the Fed funds rate and not mortgage rates. So mortgage rates right now have been trending higher. They're almost at pre-pandemic levels. And it seems like we've all forgotten about rates before COVID hit at 3.5% and maybe a little bit higher, because we've all been drinking up the sub 3% 30-year mortgage for so long. And I think mortgage rates now it's very important for us in our industry on both the realtor side and on the mortgage banking side is to educate buyers, even sellers, that mortgage rates, they are higher, but it's a perception. We have to take into account that even though they are higher from where they were a year ago, it's not something that should be a significant game changer, and it's not going to pull the legs out from the chair and the mortgage industry and the housing market go kaboom. It's just not going to happen. We all know what's going out there on the housing side as far as demand goes. There's very, very limited new homes on the market. So I think as we go throughout the year and the Fed plays their hand in regards to them raising the funds rate, we're going to start to see inflation come down. Now, inflation impacts something called a fixed income security, like a mortgage-backed security and U.S. Treasury debt. So what do mortgage-backed securities have to do to offset that higher inflation rate? Well, the rates have to go higher to offset the cost of things. Now, what the Fed plans to do is probably do anywhere between 2 to 4 rate hikes. The first one is probably going to be scheduled for the middle of March, and some are saying it could be 25 to 50 basis points, and the market's already baking that into the system. So that's a good thing. But what we all have to remember is that when the Fed raises the funds rate, historically, mortgage rates come down. So I think for the first 6 to maybe 9 months of this year, we're going to be battling with the 4% ceiling on 30-year rates. And then ultimately, I believe by the end of the year, we could see rates get back down to below 3.5% to maybe even 3% as the Fed move starts to take some traction. Now, we have to remember too, there's a buzzword that's going out there, and the media will go after you and your buyers with negativity. So what they talk about now is affordability. And one of the metrics that they use incorrectly is the amount of your household income that you use to purchase or use to pay your mortgage down per month. So let's keep it simple right now. If we keep rates where they are, we know they're higher, and let's just say home prices have gone up 10%. We know they're higher. But if your mortgage payment was $1,000 a year ago, and that price goes up 10%, or that monthly payment goes up by 10%, that's $1,100 now. If you make $5,000 a month, how much money do you have to make now in a percentage wise to offset that cost? Well, the math is pretty simple, right? So you need to offset that $100 by what? 2%. So I think the metrics that they use are incorrect when it comes to scaring people by saying homes are not affordable. Now, on the flip side now, you've got homes up 20%. So let's say that mortgage payment now is $200 higher, plus mortgage rates are almost 100 basis points higher. So now your mortgage payment goes from $100 to $1,400. Now, what of that $5,000 a month that you make do you have to offset? Now you have to offset $500 approximate dollars, or make at least 10% more of income. And if you look at average weekly earnings, not hourly, weekly, because that's what people bring home, you'll see that weekly earnings are up. And that's because the labor force is so constrained. People are leaving the market. People that are in their jobs right now want to get paid more money. So employers are paying them that money. So my argument as far as affordability goes is that I still think homes are very affordable for people. Now, you may not find the right house. You may not find that $200,000 first-time homebuyer house in 38117 right now because they just don't exist. But you may have to look elsewhere to find a $200,000 house and live outside of Memphis. So that doesn't mean that you can't get into a home right now on the lower half. So in closing, and I hope, Fara, you have some questions, or someone out there might, but I think that the Fed is not fanning the flames as far as rates go. They're doing what they can right now. I think they're doing a great job of it. And I think we just have to be very, very transparent with people when it comes to talking about interest rates going up and home prices going up, because no matter where you look, even the CFO of my company sent a message out this morning saying that the Fed's moves are sending ripples through the housing market. Well, yeah, they might be, but I think we have to defend our position and say, look, it's all transparent. If it's going to cost you $200 more a month, well, you know what? You go out once a week, one less time a month for dinner, and you don't go to Starbucks 20 times a month. I mean, just have funny conversations with your buyers like that like I do. Just tell them, look, you can make this payment work. You just have to make some changes. And then ultimately, we may end up going through another refinance boom, which could happen at the end of this year and maybe into 2023. So that's my position. I'm very upbeat on things. I'm not negative Nelly like I think the market likes to be, so they can scare people and draw them in, and then you actually push them away from the market. So I don't know. Do you have any thoughts, Fara? What do you think?
Yeah, so I'm curious to know, what is the interest rate today? As of right now, what would you say the interest rate, and I know it varies buyer to buyer, but if you were to give me like a rough range on what it is right now today.
Yeah, so I don't like to advertise a rate without an APR. So I'm going to say that a 30-year fixed rate mortgage on a conventional loan, if you did an 80% loan right now on a $400,000 purchase, you're looking at a rate somewhere between 3.625 and 3.75. And the APR above that is going to be close to 3.9. Okay. So FHA rates are a little bit lower. 15-year rates are in the high twos. So that's all with outstanding credit. Again, they vary according to the overlays with Fannie Mae and the government side. Okay.
And then Andrew, tell me what sets you apart from other lenders.
Well, I mean, what sets me apart, basically what I just told you tonight. I mean, I know a lot of people have opinions out there, but like I said, I take the data that I get. I did this for a living for 20 years. So I know what trends to watch. So I like to give the realtor and the buyers the timeline when they should win and maybe save some money by locking a rate or by locking before the market changes against them. So I watch that. And like I said, I'm readily available, which again, despite my wife saying that I have no boundaries when it comes to answering the phone, but she's right. You have to in this market. You have to be able to answer quickly and accurately. And I'm very detail oriented when it comes to getting all this stuff done. I'm very difficult with my buyers, and don't take that the wrong way. I'm very tough with them on the front end because I set expectations with them correctly and what they should expect from me when it comes through the loan process. So there are no surprises with me. I'm straight. I get everything squared away. And when you get an offer letter with my pre-approval letter attached, you know it's a good loan. So I'd like to say that that's what really sets me apart.
Love it. Thank you for being with us today. I really appreciate you. This is being saved. So if people missed it right now, I hope you'll go back and watch it and hopefully get a little taste of what loans are, where loans are, what interests are, what's Andrew O'Fee's predictions for 2022. He's a lot more optimistic than when we have one-on-one conversations. I'm usually the optimist and he's usually the pessimist. So to hear him say he's optimist makes me twice as much of an optimist. So that's a good sign. So if you're looking for a lender, Andrew O'Fee with Crump Mortgage, strongly, highly recommend him. And if you're looking for a realtor, I hope you would choose Captain & Co. We have plenty of good realtors in our company that would love the opportunity to assist you. Have a good day. Thank you so much.